Welcome to the Maybe Not So Great Books channel, You Decide. This is lesson 4 of 14, The Defensive Investor's Playbook, from The Intelligent Investor. The definitive book on value investing by Benjamin Graham, commentary by Jason Zweig. What if the smartest investment strategy is deliberately choosing to do less?
You know, it is a really provocative question.
Yeah.
Especially in a world that is just absolutely obsessed with the cult of maximum effort.
Oh, totally. I mean, think about literally every other aspect of our lives. If you want to be a surgeon, you don't dabble, you study for 12 years.
Right, you do the residency.
Exactly. The residency, the fellowship, the 80-hour weeks. Or if you want to be an Olympic athlete, you train until you vomit. The cultural narrative is crystal clear. Input equals output. Effort equals results.
Sweat equity.
Yeah, sweat equity. If you aren't sweating, you aren't winning.
We are so conditioned from grade school, really, to believe that the harder we try, the better we do. And to be fair, in like 99% of human endeavors, that is completely true. If you practice piano for 4 hours a day, you will absolutely be better than the guy who practices for 10 minutes.
Mm-hmm.
If you put more work into your business, it generally grows.
Makes sense.
But Ben Graham, writing way back in 1949, drops this absolute bomb on us. He argues that investing is the one unique place in human existence where trying harder doesn't necessarily mean you make more money.
Which is wild to think about.
It is. In fact, he argues that for most people, trying harder is exactly how you go broke.
It's the ultimate counterintuitive take. It feels almost, it feels wrong to say it out loud, like we're just endorsing being lazy.
I know what you mean.
So today we're doing a deep dive into the concept of the defensive investor. And I want to clear the air right away because, for you listening, defensive probably sounds, it sounds kind of wimpy.
Yeah, it sounds like playing scared.
Right. It sounds like the person who hides under the bed during a thunderstorm while everyone else is out, chasing tornadoes and living life.
It really does have that connotation. We associate defense with losing, or at least with merely surviving while other people thrive.
Like defense wins games, but offense gets the glory.
Exactly. But Graham is very specific here. Defensive does not mean fearful. It doesn't mean weak. It actually means creating a fortress.
A fortress.
Yeah, it means building a portfolio that is so structurally sound that you can essentially ignore it and just go live your life.
Mm-hmm.
It's about prioritizing safety and what he calls freedom from bother over the intense stress of trying to outsmart the market.
Freedom from bother. I genuinely love that phrase. It sounds like a luxury spa package. I'd like the freedom from bother massage, please.
Sign me up.
But I think for a lot of our listeners, freedom from bother sounds nice, but getting rich sounds a whole lot better. So we really need to understand why Graham thinks this bother, this intense effort, is actually dangerous.
Right, and to understand that, we have to look at how Graham defines the game itself. He starts chapter 20 with this quote that I think really frames everything we're going to unpack in this deep dive.
Lay it on us.
It's a paradox. He says, "To achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks."
Okay, let's just stop there for a second. That is the paradox of excellence right there. But I have to push back on the language a bit.
Go for it.
Satisfactory. It sounds like getting a C+ on your report card. It sounds like settling. It sounds like mediocrity. I mean, who wakes up in the morning, looks in the mirror, and says, I really want to be satisfactory today?
I get that completely. In our modern lexicon, satisfactory implies just barely good enough. But in the context of investing, Graham is using a very specific, almost mathematical definition.
Okay, so what does he mean by it?
Satisfactory means capturing the market return. It means your money grows with the economy. It means you are preserving your purchasing power against inflation and building wealth over time.
Oh, okay.
That is the easier than most people realize part. You can do that with very little effort. If the American economy grows, you grow.
Okay, so satisfactory essentially means I'm doing as well as the entire collective engine of capitalism is doing, which isn't a C+.
Precisely.
Yeah.
Historically, that's doing pretty darn well. That's how you retire comfortably and leave money to your kids. But the second half of that quote is the real warning.
To achieve superior results is harder than it looks.
Exactly. The gap between doing okay, which is actually doing quite well, and consistently beating the market, is not a small step. It is a massive, gaping canyon.
And most of us think we can just casually jump that canyon, don't we?
We really do.
Because we see the headlines. We see the guy on Reddit who turned $5,000 into $1 million overnight on some obscure crypto coin. We think, well, I'm smart. I have a college degree. I read the financial news. I can definitely do that.
We do. And that right there is the trap. And that's the ego trap. Graham classifies investors into two very distinct camps, the defensive and the enterprising.
And enterprising sounds like the go-getters.
Right, but enterprising isn't just someone who really wants to make money. That is someone who treats investing as a full-time business.
A business, not a hobby.
Not a hobby at all. They are willing to put in forensic accounting work, analyze 10K reports line by line, track liquidity ratios, interview corporate management, and honestly, handle immense psychological pressure. They're willing to treat it like a demanding second job.
So enterprising isn't just me buying a hot stock on an app while I'm waiting in line for coffee. Enterprising is, I am a professional analyst in all but name.
Yes, exactly. And the defensive investor.
That's everyone else?
It's everyone else.
Right.
It's the person who has a job, a family, hobbies, and frankly, better things to do than stress over ticker symbols all day.
Makes sense.
Graham's argument is that most people actually believe they are enterprising because they're smart, successful professionals in other fields like law or medicine or engineering, but they're actually defensive investors living in denial.
Ouch. That stings a little. It's like telling someone they aren't a chef just because they watch a ton of cooking shows. You're not a chef, you're just a person who really likes to eat.
It's not an insult, though. And that's the crucial point we have to get across to you today. Choosing to be a defensive investor isn't some consolation prize for people who aren't smart enough.
Right.
It is a strategic choice for the wise. It's what I like to call the art of strategic laziness.
Strategic laziness. I like that.
You are actively deciding that the marginal benefit of trying to beat the market, which is statistically very unlikely, isn't worth the massive risk of underperforming it. You are choosing to win by not losing.
Strategic laziness. I am absolutely on board with that. It sounds efficient. So if we accept that we are defensive investors, or at least that we really should be, what does the playbook actually look like? Because Graham isn't just saying buy safe stuff and hope for the best, right? He has an actual system. He's an engineer at heart. He loves rules.
He definitely loves rules.
Yeah.
And it's a system built on two main pillars, simplicity and automation. He wants to remove the human element, specifically the emotional element, as much as possible.
Because human emotions and money do not mix well.
They are a toxic combination.
Yeah.
He wants to save you from your own brain, because your brain is biologically wired to do the exact wrong thing at the exact wrong time in the stock market.
And the foundation of the system is the famous 50-50 split. This comes up in Chapter 4, General Portfolio Policy. Let's really break this down for you.
Right, so Graham proposes a rule that is almost shockingly simple. He says the defensive investor should aim to keep roughly 50% of their money in high-grade bonds and 50% in high-grade common stocks.
Okay, 50-50. Stocks and bonds, it seems, I don't know, rigid? Is it a hard and fast law? Like if I'm at 51%, am I breaking the Graham law?
It is rigid by design, but there's a little bit of flexibility built in. He says you can shift it a bit, maybe go up to 75% stocks if the market is bargain basement cheap, or drop down to 25% stocks if the market is dangerously high.
But generally,
you hover right around 50-50. The default state is balance. The center of gravity for your money is absolute equality between the two asset classes.
But why though? Why not just go 100% stocks if stocks generally make way more money over the long run?
That's the modern argument, sure.
Yeah, we have over 70 years of data since Graham wrote this showing that stocks outperform bonds significantly. Why intentionally anchor yourself with 50% bonds, which, let's be honest, are kind of boring?
Because of the thermostat mechanism. This is the absolute psychological genius of the rule.
Okay, explain the thermostat.
It's not just about math, it's about behavior modification. Imagine you have $10,000. You put $5,000 in stocks, $5,000 in bonds. Simple.
Got it.
Now imagine the stock market goes on an absolute tear. It booms. Everyone is celebrating. Your stocks grow and are now worth $7,000. Your bonds are still hovering around $5,000. You're now heavily weighted towards stocks. You're at like a 60-40 split.
Right. And I'm winning. I feel amazing. I'm checking my account every single day, feeling like an absolute genius. I'm literally looking at boat prices on my phone.
You feel great, and your instinct, your basic human nature, is to buy more stocks because they're going up. You want to ride that wave.
Obviously.
That's greed. That's FOMO. You think stocks are the future, bonds are for losers, let's go all in. But Graham's rule steps in and says, stop. You are now off balance. You need to get back to 50-50. So what do you have to do?
I have to sell some of the Starks, my big winners,
Yeah.
and buy more boring bonds.
Exactly. The rule forces you to sell high. It forces you to take chips off the table when the casino's actually paying out. It forces you to act completely against your own greed.
Which is incredibly hard to do on your own.
Almost impossible. Now let's reverse it. The market crashes. Panic is everywhere. The financial news is screaming that the world is literally ending.
We've all been there.
Your stocks dropped from 5,000 down to 3,000. You are now very bond heavy in your portfolio. You're terrified.
Yeah.
You want to sell everything and just hide your money in cash under the mattress.
Get me out of the market.
Right. But the rule says, stop. You need to get back to 50-50. So what do you do now?
I have to sell some of my bonds, the only things that actually held their value, and use that cash to buy the stocks that just crashed and burned.
Which means the rule forces you to buy low. It forces you to be a contrarian when every single fiber of your being wants to run away with the herd.
Wow.
It acts exactly like a thermostat, regulating your portfolio's temperature so you never get too hot with greed or too cold with fear. It completely removes the need for you to predict the future. You are simply reacting mechanically to the present imbalance.
That is actually brilliant when you lay it out like that. It takes the whole, I feel like the market is going up guesswork completely out of the equation. You just look at the math. If the numbers are skewed, you fix them. It turns investing into a chore, essentially.
A chore is a perfect way to describe it.
Like doing the laundry. You don't get super emotional about laundry. You just do it when the pile gets too big.
Precisely. And chores get done. Dreams just get thought about. This system protects you from yourself. It converts market fluctuations from a source of terror into a source of mechanical action.
So that's the underlying structure. But how do we actually put fresh money into this structure?
That brings us to another Graham favorite, something I think most people listening have probably heard of but maybe don't fully appreciate. Dollar cost averaging.
Yes. Chapter 5. This is genuinely the secret weapon of the defensive investor.
Secret weapon makes it sound so exciting, but isn't it really just buying a little bit every month?
It is, but the mathematical power of it is so often underestimated. Dollar cost averaging simply means investing a fixed amount of money at regular intervals, say $500 on the first of every single month, regardless of what the market is doing.
Rain or shine, bull market or bear market. Even if every pundit says a massive recession is coming tomorrow.
Especially if the pundits say a recession is coming.
Yeah.
Here is why it works. It's simple arithmetic, but it feels like magic when you see it play out.
Yeah.
Let's say you have $100 a month to invest. In month 1, the stock price is $10. You buy 10 shares. Very easy.
Right.
In month 2, the market crashes. The stock price drops to $5. It's a total disaster right now.
Yeah.
It definitely feels like one. I just lost half my money from month 1. My $100 became $50. I'm sweating.
But you have another $100 to invest for month 2. At $5 a share, how many shares does your $100 buy you now?
20 shares.
Exactly. You bought 10 shares when it was expensive, and you bought 20 shares when it was cheap. You are automatically buying more of the asset when it is on sale and less when it is overpriced.
That makes total sense.
Your average cost per share ends up being lower than the average price of the stock over that same time period. You are effectively rooting for the price to drop while you were in the wealth accumulation phase of your life.
It turns volatility into an absolute advantage. Instead of dreading the market dip, you're kind of welcoming it because you know your monthly contribution is going to work that much harder.
Exactly.
It's like going to the grocery store and finding out ribeye steak is 50% off. You don't stand there and cry about the steak you bought last week at full price. You stock up on the cheap steak right now.
That is a great analogy. And Graham backs this up with hard data.
Yeah.
He cites a study by Lucille Tomlinson. She was a pioneering analyst, really ahead of her time in the field.
What did she find?
She tested this exact method over 23 distinct 10-year purchase periods, ending in 1952. She included the Great Depression, the post-war boom, everything, the absolute worst times in history to invest.
And
She found that every single 10-year period produced a profit.
wait, every single one, even if you started buying right before the infamous 1929 stock market crash?
Yes. Think about the mechanics of that. If you put a lump sum in right before the 1929 crash, you were decimated. It took roughly 25 years just to break even on that money.
Quarter century just to get your money back.
But if you were dollar cost averaging, you kept buying all the way down the cliff. You bought shares at $30, then 20, then 10, then 5. You accumulated huge, massive numbers of shares at rock bottom Depression-era prices. So when the recovery eventually came, even just a partial recovery, your portfolio absolutely exploded in value because you own so much more of it.
That is wild. It basically inoculates you against bad timing. Graham calls this the formula for ultimate success. It's so mind-numbingly boring that people just ignore it, but the math is undeniable.
It completely removes the timing risk. You don't have to worry about buying at the top because you're automatically also buying at the bottom. And frankly, for the defensive investor who is busy actually living their life, it's the only practical way to invest. You set it and forget it.
Okay, so we have the 50-50 split and we have dollar cost averaging. That gives us a really solid framework. But Graham is a storyteller too. He doesn't just give us cold formulas, he gives us characters.
He really does.
In Chapter 5, he introduces us to a specific investor profile to illustrate this whole point. The widow with $200,000. Let's talk about her.
Yes. Now, we have to contextualize this number for a second. In 1949, $200,000 was a massive fortune. That's millions of dollars in 2026 purchasing power.
So she's not struggling.
Right, this isn't someone scraping by. This is a very wealthy individual.
Yeah.
But her psychology and her situation are incredibly unique.
She's wealthy, but she's vulnerable.
Exactly. She needs income to live on for the rest of her life. She has children to support. She is rightfully concerned about inflation eating away her wealth over the decades.
But no finance background?
Zero experience in finance and absolutely no desire to become a day trader. She is the perfect target for every predatory salesperson on Wall Street.
So the typical Wall Street advice, certainly back then, and honestly we see this all the time today, might be, hey, you have massive capital, let's get aggressive. Let's find the next hot growth stock to make you even richer. You can afford to take risks.
Oh, entirely. They'd say, let's put you in these high-yield speculative bonds, or let's buy into this brand-new post-war technology.
Those are the dream.
But Graham looks at her situation and says, no, absolutely not. Her goal isn't to multiply her wealth. Her goal is adequacy. Her goal is peace of mind.
Adequacy over maximization.
He advises her to split the money between government bonds for absolute, unquestionable safety and a diversified list of leading common stocks just to protect against inflation.
It goes right back to that satisfactory versus superior thing we talked about earlier. For the widow, a superior return simply isn't worth the risk of a disastrous loss.
Precisely. If she tries to be enterprising and fails, her lifestyle is destroyed. She can't go back to work to make it up. She can't earn it back.
The stakes are too high.
But if she stays defensive and just gets a satisfactory return, she stays rich and she sleeps well every single night. The defensive strategy is really about matching your investment style to your actual life needs, not just blindly chasing the highest number on a screen.
It's about recognizing when you have enough and actively protecting it.
Yes.
The definition of winning for her isn't more money, it's unbroken sleep.
Unbroken sleep. I love that.
I think that's a lesson a huge number of people miss today. We assume the goal is always maximum returns, but sometimes the goal is maximum sleep.
Very true.
But Graham doesn't just broadly say buy stocks. He's very, very particular about which stocks the defensive investor should actually buy. In Chapter 14, he drops this checklist. And I have to say, looking at this checklist today, it's intense. It's not just buy what you know.
It is incredibly strict. This is the defensive stock selection criteria. It's not a vibe check. It's a rigorous mathematical filter.
Let's go through it.
He lists 7 distinct requirements that a company must meet before defensive investors should even think about touching it. And we should really walk through them because it shows just how high his standards were. He basically treats buying a stock like hiring a CEO to manage your family's future.
Let's run through them. I genuinely want to see if we can even find a company today that fits this profile.
Okay, requirement number 1, adequate size. He wanted big companies. In 1972, that meant at least $100 million in sales. Today, that would be multiple billions.
Okay, why size?
He wanted insulation from the chaos of small business.
Yeah.
He didn't want you buying a scrappy startup that might just disappear in a year. He wanted the absolute giants that have total market dominance.
Okay, that's easy enough. We have plenty of giants today. Amazon, Google, Walmart. We can check that box easily.
Sure. But then we get to number 2, strong financials. Specifically, a current ratio of 2-to-1.
Hold on, let's define that for everyone. Current ratio. That sounds like deep accounting jargon.
It is, but the logic is actually very simple. It's a measure of liquidity. You take the company's current assets, so that's cash in the bank, inventory sitting on the shelves, things they can sell quickly, and you divide it by their current liabilities.
Which are the debts due within a year, bills they have to pay right now.
Exactly. Graham demanded that the assets be double the liabilities. It's a fortress balance sheet. If the entire economy stops tomorrow, this company can literally pay all its short-term bills twice over.
Okay, that's strict. A lot of modern companies run way leaner than that today. They want to be capital efficient, so they don't keep that much cash just sitting around doing nothing.
They do. But Graham didn't care about efficiency anywhere near as much as he cared about pure survival.
Okay, fair enough. What's next?
Number 3, earnings stability. Positive earnings for 10 years straight. No bad years allowed.
10 years.
10 straight years. No excuses like, we lost money because we were investing heavily in growth. You have to be profitable every single year for a decade.
That rules out a massive chunk of modern tech companies that run at a loss to grow market share. I mean, Uber, for example, went years and years without a profit. Graham wouldn't touch that.
He would run screaming from it. Which brings us to number 4, dividend record. 20 years of continuous payments.
20 years? You're kidding.
20 unbroken years. He wanted to see that the company was deeply committed to returning cash to shareholders through thick and thin, through recessions and booms. Dividends are proof of cash. You can fake earnings on a spreadsheet with clever accounting, but you cannot fake a physical check mailed to a shareholder.
That is a great point. Dividends are basically the corporate lie detector test. Okay. Number 5.
Earnings growth. At least 33% growth over the last 10 years. He wanted stability, sure, but not stagnation. He needed to see the company actually moving forward, consistently beating inflation.
Okay, so let's recap. Big, incredibly safe, profitable for a decade, paying dividends for 2 decades, and growing steadily. Sounds like the perfect company. Why wouldn't everyone just buy these?
Because of the price tag. This is where the modern market hits a massive brick wall. Number 6, moderate PE. The price-to-earnings ratio shouldn't be more than 15 times the average earnings of the last 3 years.
15 times. The S&P 500 average is often way, way higher than that. I mean, tech stocks trade at 30, 40, 50 times earnings. NVIDIA has been astronomical.
Right. And then there's number 7, moderate price to book. The price shouldn't be more than 1.5 times the book value of the assets.
Let's clarify book value.
That means if a company owns factories and land and cash worth $1 billion, the stock market value of the company shouldn't be more than $1.5 billion.
1.5. I feel like most companies today trade at 5 or 10 times book value, especially tech companies where their assets are code and brand recognition, not physical factories.
Absolutely.
If you look at a software company, their physical book value is basically a few hundred laptops and a really nice office espresso machine, but the market says they are worth $20 billion.
Exactly. So if you take my smartphone right now and open up a stock screener app and you painstakingly punch in the 7 criteria for the U.S. market in 2026, what do you think you find?
I'm guessing. Practically nothing.
You find a ghost town. Almost 0 companies.
Really?
There was a Portfolio 123 analysis done on this exact screen. You might find a handful of regional banks or boring insurance companies, or perhaps an energy company in a deep slump. But generally speaking, the cupboard is completely bare.
So wait, if the checklist is literally empty, is the advice useless? Did we just spend 10 minutes talking about an investment system that fundamentally does not exist anymore? Is Ben Graham obsolete?
Not at all. It actually tells you something profound about Graham's underlying philosophy.
Which is?
He would genuinely rather buy nothing than buy something unsafe. He was perfectly willing to sit in cash or bonds rather than overpay for a quality stock just to be in the game. He didn't suffer from that modern, I have to be in the market itch.
Right.
But you are right, it highlights a huge practical problem for the modern investor. If you follow Graham's 1972 rules to the exact letter today, you effectively cannot invest in the stock market. You'd have been sitting on the sidelines in cash for the last 30 years, missing out on massive, life-changing growth.
So we obviously need to adapt. How do we bridge the gap between 1949 and 2026? Because clearly, going out and searching for stocks with a PE of 15 and 20 years of dividends isn't going to build me a retirement portfolio today.
This is where the story gets really interesting. Because Graham himself actually evolved on this.
He did.
Yes. We have this amazing historical source, an interview he gave in 1976, just a short time before he died. And he basically admitted that the market had fundamentally changed.
What did he say?
He said that the market had become so efficient and professional investors had become so incredibly smart and well-resourced that trying to pick individual stocks using these complex checklists just wasn't worth the effort anymore for the average person.
Wait, the father of value investing, the guy who invented stock analysis, said stop picking stocks.
He did.
That's like the Pope saying, you know what, stop going to church, it's fine.
Essentially, yes. For the defensive investor, at least. He pivoted. And if we translate his defensive philosophy, safety, broad diversification, extreme simplicity into the modern world, the answer is so obvious. It's the exact solution Graham wished he had back in 1949.
You're talking about the index fund.
The index fund.
Yeah.
Specifically, a low-cost total stock market index fund. Think about his checklist and apply it to an index.
Okay, let's do that. Diversification.
Yes, you own literally everything. You own the banks, the tech companies, the energy sector, the retail giants, all of it.
Confined to important companies.
Yes, the index is naturally dominated by the biggest, strongest, most profitable companies in the world.
Zero effort.
Absolutely zero effort. You just buy one ticker symbol.
So the modern defensive investor isn't a stock picker at all. They are an indexer. They aren't looking for the needle in the haystack. They're just buying the entire haystack.
Why in the haystack, exactly. John Bogle famously said that, and it's the direct descendant of Graham's thought. And if you want to take strategic laziness to its absolute peak, which I think Graham would give a standing ovation to,
Yeah.
you look at something like a target date fund in a normal 401k.
Right, those funds where you just pick the year you think you want to retire, say the 2050 fund, and it does literally everything for you in the background.
It handles the 50-50 split, or whatever ratio is appropriate for your specific age. It handles all the mathematical rebalancing. It handles the global diversification.
Without you lifting a finger.
Right. It automatically shifts from risky stocks to safer bonds as you get older and closer to needing the money. It is the absolute purest implementation of Graham's defensive philosophy that exists today. It is automation perfected.
It's funny because people think target date funds are so boring. You hear people say, oh, that's just what my HR department defaulted me into. I want to pick my own investments. But listening to you explain it, it sounds like they are the ultimate financial fortress.
They are a fortress. Boring is good in investing. Boring makes you rich over time.
I love that.
Excitement is what you pay for at an amusement park. Boredom is what pays you in the market. If your investing strategy is highly exciting, you're probably doing it wrong.
However, there's always a however in the deep dive. We can't just blindly follow a book from 70 years ago without looking closely at the macroeconomic context. We touched on the 50-50 split earlier.
Sure.
50% bonds.
Right. And this is what we call the interest rate trap. You have to be very careful here. When Graham wrote the 1972 revised edition, high-grade corporate bonds were paying about 7.5% interest.
7.5% guaranteed. That's amazing. I'd take that in a heartbeat today. If I could get 7.5% risk-free, I wouldn't even bother with stocks at all. I'd put it all in bonds and sit on a beach.
Exactly. If you can get 7.5% risk-free from bonds, holding 50% of your portfolio in them is an absolute no-brainer. You have a massive, comfortable income cushion. Your money doubles every 10 years without you doing a single thing.
But that's not our reality.
No. Look at the last 15 years. We've had long periods where bond yields were 1%, 2%, maybe 4% if you're lucky.
And if inflation is running at 3% or 4% and your bond is only paying 2%,
you are locking in a mathematically guaranteed loss of purchasing power. You are losing money safely.
Losing money safely, that's a grim way to put it.
But it's true. And that is not what Graham intended. He hated inflation. He famously called it a silent thief. So strict, unthinking adherence to the 50% bonds rule in a chronically low interest rate world can actually be incredibly dangerous.
So the math changes.
The principle of balance is forever true. You absolutely need some safe ballast in the boat so you don't capsize. But the specific ratio might need to change based on the era. Maybe a younger investor today needs to be 80-20 or even 90-10.
So don't worship the specific number 50, worship the underlying concept of balance.
Correct. You have to understand the why, not just blindly copy the what. If bonds simply aren't paying a real return, you might need to look for other safe harbors. But the idea of not being 100% exposed to severe risk remains entirely valid.
Now, the other big limitation is this idea of being passive. We used the term strategic laziness earlier, but Graham actively warns us not to completely fall asleep at the wheel, right?
Yes, very much so. There is a huge critical difference between being defensive and being comatose. Graham brings up massive cautionary tales like Penn Central.
Penn Central, the railroad company, that was essentially the Enron of its day, right?
Exactly. In the late 1960s, Penn Central was a blue-chip behemoth. It was considered as safe as the U.S. government. It was the absolute dictionary definition of a defensive stock. People bought it for their widows and orphans to provide safe dividends forever.
But underneath the hood,
Underneath, it was rotting from the inside out. It had taken on massive debt, it was incredibly mismanaged, and it was literally borrowing money just to pay its dividends to keep up appearances.
And if you were just strictly passive, if you bought it because it checked the boxes and then threw the quarterly statements in a drawer without looking, you got completely crushed.
You got wiped out. The stock went to zero. It went bankrupt in 1970. It was the biggest corporate bankruptcy in U.S. history at the time.
Wow.
The lesson there is that if you insist on picking individual stocks, you simply cannot be passive. You have to watch them constantly. You have to continually monitor that current ratio. You have to read the annual reports to make sure the fortress is still a fortress.
But if you are in an index fund...
If you are in an index fund, the index does that monitoring for you automatically. Penn Central naturally gets kicked out of the index when its market cap collapses. Enron gets kicked out. Blockbuster gets kicked out.
The trash takes itself out.
Exactly. You personally don't have to sell them. The fund manager removes them mechanically. This is exactly why indexing is vastly safer than defensive stock picking for 99% of people. Automation is so much safer than just blindly holding a single stock forever and hoping for the best.
That's a really, really important distinction. The index is self-cleansing. Your personal hand-picked portfolio is not.
Absolutely. The index is a ruthless survival of the fittest machine. It only keeps the winners.
Okay, I want to pivot to the debate section of our show now, because I know exactly what some of our listeners are thinking right now. We've been sitting here talking about 50-50 splits and index funds and being defensive and avoiding bother.
And they hate it.
They are thinking, boring. I want to get rich. I miss Bitcoin. I miss the early days of Amazon. I miss the massive AI boom of the early 20s.
The classic FOMO argument. Fear of missing out.
Yes. If I am a strict defensive investor, am I not mathematically guaranteeing mediocrity for myself? Am I not guaranteeing that I will never, ever have that life-changing, buy a yacht, generational money? Why should I consciously settle for satisfactory when I open Twitter and see people making superior returns?
This is the eternal battle. The JOMO argument joy of missing out versus FOMO. And it's really the central tension of Graham's entire book.
What's Graham's response to that FOMO?
Graham would argue very simply, you aren't missing out on gains. You are actively avoiding ruin.
Okay, say more about that. Because avoiding ruin sounds intellectual good, but gaining millions of dollars sounds emotionally way better.
Let's talk about the math of loss. This is something human brains are just notoriously bad at understanding intuitively.
Okay, hit me with the math.
If you decide to be an enterprising investor and you take a massive swing at a speculative tech stock or some new crypto coin and it drops 50%, do you know how much you have to make on the rebound just to get back to even?
Well, basic logic says if I lose 50%, I need to make 50% to get back to where I started.
No. And that right there is the trap. If you have $100 and it drops 50%, you now have $50.
Right.
If you make a 50% return on that remaining $50, you only gain $25. You were sitting at $75. You were still down big.
Oh.
To get from $50 back to your original $100, you have to completely double your money. You need a 100% return just to get back to the starting line.
Oh, wow. Put that way, losing 50% is an absolute disaster.
It is a mathematical catastrophe. And if you take a really bad flyer and lose 75%, you need a 300% return just to break even.
That's sobering.
Graham's entire philosophy is based on the fact that avoiding that 50% hole in the first place is far, far more important to your long-term wealth than trying to blindly guess which stock is going to go up 100%. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1.
It's the avoid stupidity strategy versus the seek brilliance strategy.
Yes, beautifully said. And Graham would ask that Twitter trader, are you really willing to treat investing as a business? Are you staying up until 2 a.m. reading the 10Ks? Are you calculating the hidden liabilities on the balance sheets?
Probably not.
Are you willing to control your emotions when everyone else around you is absolutely panicking? If the honest answer is no, then chasing greatness isn't investing at all. It is literally just gambling. And the house always wins eventually.
So the debate really isn't average versus great. It's safe versus disaster.
For 99% of the population, yes. And the empirical evidence is overwhelming. Look at the professionals. Most professional mutual fund managers, people with Ivy League finance degrees, $10,000 Bloomberg terminals, and supercomputers fail to beat the basic index over the long run.
Really? Most of them?
Yes. 80 to 90% of active managers underperform the simple, boring defensive index fund over a 15-year period.
That is insane.
If they can't do it with all their resources, Why on earth do you think you can do it by reading a Reddit thread on your lunch break?
That is a very humbling splash of cold water, but probably deeply necessary. It's hard to hear because, we all want to be the exception. We all want to be the hero of our own financial movie.
I get it. But in the world of investing, the true hero is the one who retires comfortably and stress-free, not the one who makes the most exciting trades at parties.
So let's bring this home for the listener. We've talked about the history, the theory, the stories, the modern limitations. What is the ultimate takeaway here? What do you listening actually do on Monday morning?
The takeaway for this specific lesson isn't actually a financial transaction. It's an audit, a personal identity audit.
The mirror test.
The mirror test. I want you to walk into your bathroom, look in the mirror, and ask yourself with brutal honesty, am I genuinely willing to do thorough accounting analysis, read boring financial statements, and track corporate ratios for 20 hours a week?
And be honest with yourself. Not would I ideally like to be that person, but will I actually do the work? Will I give up my Saturday mornings to read an obscure company's annual report?
Right. And if the answer is no, which, let's be real, it absolutely is for most of us.
Then you are a defensive investor.
Yes, embrace it. Stop acting like a day trader. Stop checking your portfolio app every single hour. Stop watching cable financial news that is entirely designed to make you panic and trade.
And practically speaking, what buttons do I actually push on my computer?
Log in and check your portfolio. Is it balanced? Do you have that structural fortress of stocks and bonds, or cash equivalents if rates dictate? Is it broadly diversified?
Check the structure.
And most importantly, is it automated? The specific challenge I would give you is this. Set up an automatic monthly transfer, that dollar cost averaging we talked about, into a broad total market index or an target date fund.
Just set the schedule.
Set it for the exact day after your paycheck hits your account so you never even see the money. You can't spend what isn't there. And then do the hardest thing of all.
What's that?
Do absolutely nothing else.
Do nothing.
Go for a walk, read a novel, play with your kids, focus on your actual career. Just let the system work quietly in the background.
Strategic laziness.
Strategic laziness.
Yeah.
It is truly the smartest financial move you will ever make.
I love that. It's not just investment advice, it's honestly life advice. Stop trying to optimize every single variable and just build a system that works so you can actually go live your life.
That is exactly the Graham way.
That was lesson 4 of 14 on The Intelligent Investor, the definitive book on value investing. Subscribe for the full series. If you haven't seen our debate overview of the whole book, check that out, link in the description. Thanks for being here. See you next time.